put this
Yeah, we
out.
really live. There we go. We live. What's up? What's up? What's up? Welcome back to Stock Plug Investments, man. What's good with y'all, man? Yeah, today we got a good class for y'all, man. Or got some good information for y'all. This ain't no class. We got some good information for y'all today. Put up this post, let them know we're going live real quick.
Welcome back, everybody. Welcome back. We're about to be talking about dividends, the benefits of dividend investing, man. One of my favorite strategies of investing, making money in the market. Literally my favorite strategy right here.
And bruh is a dog with the dividends too, man. Like, I wish I was doing it as heavy as you was when you first started. For real, I'll be out of here right now, for real. Like,
hey, for real. I was looking at some returns like you was investing 8-10 years ago.
Yeah.
Man, you've been up.
Yeah. I'm tight. I went heavy on it like you was.
Right, yeah. Hey, but now your chance, man.
Oh yeah.
Ain't never too late, man. For real. People make $1 million within a year sometimes. Like, it don't always happen, but if you lock in and focus up, you definitely can make that happen, man.
Yeah, that's true, man.
But yeah, if anybody got any comments, y'all can ask right quick before we get going.
All right, just sent it out.
But I'm gonna go ahead and get started. We started a little late today, but y'all should understand, man. You know what I'm saying?
Yeah.
But yeah, we can go ahead and get started again. So basically, today we're talking about the benefits of dividend investing. We're gonna start off with different advantages of dividend investing. We talked about this in I think like our first or second video, but I'm gonna re-explain it so y'all can understand it and all that, because this is like real important information of new investors. When y'all first start investing, it's better to start dividend investing. We really encourage that for anybody that's new in the market to just start strictly dividend investing. Like, it's cool to invest in stock that don't pay dividends, but it's better to invest in stock that do pay dividends. Like, so.
They must less volatile.
Yeah, definitely is. Yeah, and they definitely don't move as much. Like, Apple will be up one day, then down the next. Tesla go up and down hundreds of dollars on subs. So, and down pay a dividend too. So, like, if you was investing into Tesla, you would see your money just fluctuating all the time instead of it just being at a nice price and you receiving dividends over time. But yeah, so basically, number one is get paid to wait. I'm gonna just explain everything myself because I read everything in like the first video. If y'all wanna see me read it over, just go to the other video that we did. But yeah, basically just get paid to wait. Like, over time, you literally just get paid to just wait on your stock to go up, to do whatever you expected it to do over time or whatever.
Yeah.
But yeah, dividend growth compounding. This is the most important. Let me highlight it for y'all.
Yeah.
In fact, let me zoom in too. How do I do this?
Definitely important for that compound. That's what gets you them crazy returns.
I can't even figure out how to zoom in. But yeah, I'm gonna just highlight it for y'all so y'all know where I'm at. But yeah, dividend growth compounding. Yeah, that's basically my goal in the market for the next 30 years. Is to just benefit off of the compound growth of dividends. Like, so basically, to sum this up, dividend growth compounding is, say you invested $100 in Apple today. Apple pay quarterly, meaning that they pay every 3 months. So you'll receive your first dividend within like the next 3 months. Or when do I pay? March. What is it, March? So you'll probably get your next dividend in like September, is it, of Apple? Probably September, but you will basically get your dividend every 3 months. And the compound is gonna come from them reinvesting your dividend for you. So that next payout can be even more. So that's where the compound is gonna start at, from your first dividend, reinvesting back into the other stock. So that next payment can be more, and it can just be a big snowball effect on something. But yeah, I'm gonna go through all these. Take advantage of corrections in bear markets. Basically, we talked about what a correction is and bear markets in one of these videos. Y'all probably watched all of them. Y'all probably heard. But yeah, basically, to sum it up real quick, is correction is when the time that a lot of big investors have to sell their shares or have to cash out their contracts rather, and that's basically when the market is going down a lot, and a lot of people are just selling shares in general. With dividend stocks, dividend stocks really don't go down as much in a bear market or a correction market on something like. So if you see every other stock going down 10, 20%, like big stocks like Tesla, where people bought huge contracts and they got to finally cash them out. Yeah, like stocks like those will go down a lot. And yeah, that's basically called a correction. Once it go down like 20%, right, bro? Or like 25%, that's considered a correction.
No, so like 10 to like 13 or 15% is like a correction.
Oh, so 10 plus
past
percent.
20 is like you borderline crashing.
Right. Yeah. So yeah, anything over like 10+% is basically a correction.
Yeah.
And you'll lose a lot of money within that. But if you have dividend stocks, you won't really lose as much because you're still receiving those payments. And like I said, dividend stocks don't really move as much.
Yeah.
But yeah, this next one is capital preservation. What is this? I'm not even sure what this is. I'm gonna go ahead and read it so I can understand it too, for real. But say quarterly dividend paying companies are more mature and stable than the average company. These stocks usually hold up better in down markets. Yeah, like I was saying. So it's basically saying the same thing I said with corrections in bear markets. You keep going. These stocks usually hold up better in down markets than more speculative stocks like Tesla or any other big company like that. This is especially true when the value approach with margin of safety is used when selecting stocks. So yeah, basically with dividend stocks, they considered more safe as well, because if they even got the money to pay a dividend, I mean that they make enough money to even do it. So basically they make a lot of money overall to even pay their shareholders. So that's basically what capital preservation is. So yeah, this next one, it's another reason why I dividend invest. So like in the next 10, 15, 20 years, I can actually use this money to pay my bills and my mortgage and stuff. Like I found out not too long ago that you can actually use your dividend income for like pay stubs and like tax information and stuff. Like, so basically, if I wanted to go rent out a house or go buy a house or anything, like, or even get a credit card or something like that, you can use your income, or you can basically show them your income from your stocks, and they would allow you to get loans and stuff like that, because they seeing that you're getting these monthly checks in from these dividends. So yeah, basically you can create a whole income stream, and that can just be a whole check just off straight free dividends. Like, but yeah. And then inflation hedge. We told y'all what inflation was in like, I think it's like our third video or second video, something like that. But yeah, basically inflation hedge is you hedging against inflation. Inflation is when the value of the dollar go down. So basically 5-10 years ago, y'all seen that chips was not always 59 cents. It was a quarter back then. Like, so that's basically an example of inflation right there, when the prices of goods and services go up. And your hedging is just like going against it. So basically with dividend stock, if you getting paid over time, like say, for example, you bought a $10 dividend stock 5 years ago. if you would have kept your $10 in your bank account, it would still say $10, but you wouldn't be able to buy the same thing that you could have bought 5 years ago with that. But for example, if you would have put that into a dividend stock, you would have been getting paid every month or every 3 months from that $10, and that $10 probably would have turned to like, I say 15 at the most on some what's that, a 10% return on rate or return on investment right there.
That's 50%. If it was at $10 and it went to 15, that's 50% return.
Oh yeah. So or yeah. Basically, what 5 years? 10%, ain't it? I don't know. I can't really do the math right now, but basically, if you save your $10 for it,
Oh, you're talking about like annually? What would be the rate of return?
Yeah, annually.
Oh, okay, yeah. So yeah, in 5 years, yeah, it'd be like 10, like you said, yeah.
Yeah. So basically, with your $10, you will make $1 every year rather than your $10 losing value from inflation. Awesome. So yeah, that's everything right there. If y'all want to pause the video, look at it again, screenshot it or something, y'all go ahead and do that now before we move on. But yeah, you got anything you wanted to say, bro, before we move on?
The biggest thing, man, is that that growth compounding, man. Like
it's huge.
Like huge. I learned my lesson, like, bro, when we first started doing this a few years ago, bro was heavy on the dividends, and I was just investing in regular stocks. Like I want looking for dividends.
That's cool too. Like bro's strategy is growth investing too. Like bro's investing into stocks that can grow over time, that got the what is it, the I'll say the potential to grow over time, like good companies like what was it, I'll say Netflix or something like that. Bro was investing in Netflix a few years ago, and like he knew that company was gonna go up. Like everybody watched Netflix. Don't nobody really go out and buy movies no more. They pull it up right on their screen, you know what I'm saying? So yeah, like right there, that was what is it, growth investing right there. That's cool too, but yeah, you can keep going, bro. Just for the people that think just the only way to make money is through dividends. Just wanted to let them know that income or growth investing is good too. But you can keep going.
Yeah, it definitely is. And if y'all got any questions, y'all can put them in the chat. We'll answer them. But I was about to say that like if I would have been like heavily dividend investing back then, man.
Yeah.
Man, I could just imagine how much money I would have made in like the last 5 years of investing.
Yeah,
like real, just man. Off of the dividends, bro. Like I knew what it was and I knew what it could do, but I wasn't all in on it. Yeah. Bro was all in on it, and he eating off of it now. So like now I'm about to just go full throttle, like majority, like easily 30% of my portfolio gonna be all dividends, easily 30%. Like
yeah, and that's solid. That's solid too.
I'm definitely gonna have you on.
That's basically like 1/3 of your whole portfolio. Like bro, really diverse with it. Like he can put 30% in dividends, 30% in growth investment, another 30% in what is it, contracts, options and stuff. And that's solid right there. That's a solid plan. Like, but bro got experience, so he can do that. Like, but for the brand new people, don't like go straight with like growth investing or options or anything. The first stock that you should buy is a dividend stock off rip, just so you can have that stability rather than your portfolio just looking like a roller coaster.
Yeah,
you know what I'm saying?
That or ETFs too, and some ETFs for dividends too.
Definitely SPHD, that's one of them right there. Y'all want to go look that up? Yeah, that's a good company. I'm saying I pay dividends.
But yeah, that's all I was about to say though.
For sure. We can go ahead and move on. Yeah. So I want to show y'all the potential that dividend stocks can give you. I'm gonna start off with Apple right quick. Look at that dividend yield right quick, and basically see how much return you can get on your investment through dividends, through compound dividend growth. So basically, Apple paid a dividend yield of 0.68 per share on something. So I'm about to plug this in right quick. 0.68% right here. All right, so say you put.
Go ahead. I'm about to tell him that something to keep in mind, like the lower the dividend yield is for the
The lower
stock.
you'll get paid.
Well, no, it ain't always the lower you'll get paid because the dividend yield can be low, but if the stock price is real high,
Oh, right,
you can
right,
still get a
right,
nice amount. I was about
right.
to say that the lower the dividend yield, the safer the dividend
Yeah,
is.
that's
Meaning,
another
like
thing too.
the chances of them cutting that dividend and saying we ain't paying this dividend no more is real
Yeah,
low. But if
yeah,
the rate is high, like if you get a dividend yield of 5 or 7, or
yeah.
really over 10,
I'm gonna
then
give them an example of that too on
yeah, that's
some.
really unsafe.
Yeah, yeah. But yeah, basically, like say you invested, I say $500 in Apple in 2010. So that's 11 years ago. 2010, you invested 500 in Apple at a return rate of 0.68. Paste this right here. Boom. 11 years, calculate my returns. So basically, with this, wait, hold on. Is the I don't even think they reinvest in the dividends. That's just, or is it? Oh no. This right. Because Apple don't really pay that much in dividends
Yeah.
or something. But basically, at the end, you would started off with $500 and you would end up with 538 within 11 years. That's just because Apple is a huge stock. It already, like 5 years ago, with $500, you probably was only able to get like, what was the price of Apple in 2010? Probably like $60 maybe.
I don't know for sure. I have to look at it for sure.
Basically, you probably wouldn't be able to get nothing more than 10 shares. I'd say about 8 shares at most on some, man. If they only paying around like, I think they pay like 22 cents per share or something like that every 3 months. So basically what I'm saying is it's not a lot. It's safe for sure. Like bro was saying, companies that pay lower dividend yields is safe. Like them can consider safe because they're not lending out all their money to the shareholders and they're not basically setting themselves up for bankruptcy on some. So yeah, that's just 11 years though. But say you did that for 30 years, you put $500 in 1990 or 91 rather for 30 years on some, and their return rate probably was different back then, but I'm gonna keep that in.
Yeah.
So yeah. Basically, if you put $500 in Apple for 30 years,
one time. That's only one time investment of $500.
Right, without investing no more of your bread, you could have came out with 612, and that's without investing no more cheese. That's better than you just leaving it in the bank account for 30 years. Because 30 years ago, $500, you probably could have got a lot, honestly. Like, but today with $500, you probably couldn't really get much. But the thing is that you basically hedging against inflation on something. Yeah. So with you just investing in Apple would have made you money rather than you losing money. Now let me go to a stock that got a way higher yield.
And some y'all want to keep in mind with these dividend stocks, man. These ain't like you just buy one dividend, you buy one share and like, oh, that's enough. I got my feet wet. You got to keep buying these. Like,
yeah, exactly.
Dividend plays, man. We hold these for 5 to 10 years. Like,
exactly. And that's just 500. Like, let me plug in a different amount. Let me see. Let me do, for example, say you put an extra $100 in Apple every year after that 500. So that's another 2,900 that you would have did throughout 30 years.
Yeah.
So 2,900 plus 500, that's 3,400 you would have had in Apple. Right there, you would have just invested a small extra $100 a month or $100 a year with Apple for 30 years. See how much you would have had.
And that's slight.
4,100 right there.
The numbers start going crazy.
Yeah. Like the more money that you got invested within dividend companies, the more you will get paid on something. And that's slight for real. Like that's only $100 every year. Like, but for example, the quicker you invest, the more you can get paid too. That's why I'm so bullish on dividend stocks, because I'm 21 years old, you know what I'm saying? I got time the rest of my life, you know what I'm saying? Yeah. So within the next 30 years, I can chill. Like I ain't really got to worry about spending money. I can invest some money and let it chill, you know what I'm saying? I still got a lot of time basically in my life, is what I'm saying.
Yeah.
So the earlier you invest, the more you can get paid too. So I'm gonna do another example. Say you did $100 every month for 30 years. What's that? 12 months.
Yeah.
Let me see. 12 times 30.
Yeah.
Let me see. What's that? Pull up my calculator right quick. Okay, so 360 times 100. You would have invested $100 360 times 100 times 360. Okay, so that's 36,000 you would have had invested within 30 years if you would have literally put $100 a month into Apple. Let's do the math right quick. And I ain't saying like 30 years is a long time, you know what I'm saying? Like, but you can start whenever. Like this is the past. Like we really can look at the future, honestly. Like for the people that's young or for the people that probably want to buy stocks for their kids or whatever, you definitely can do that. So like basically for the next 30 years, if you invest $100 every month, this is how much you will make. That's 36,000 for the next 30 years, $100 a month. Boom. So yeah, your first year you will make $244, and it just keep compounding every year after that. We're gonna go to the bottom, and just with $100 a month for 30 years, you can come out with almost $45,000. That's an extra 15, or no, that's an extra 10. Yeah, I say almost 10K just over a 30-year strand on something like, or span, I mean.
And that's not even stock price going up though.
Right, yeah, that's another thing too. That's why I knew something was up with this.
That's not even in there.
Right, yeah. I couldn't find like another calculator that like calculate the stock price with the dividend yield and all that.
But you can't. It's hard to do that because you don't know where the stock gonna be at. Like you can't project it out like that. Like
right.
You have to do it off of past history and all that.
Exactly. This is just basically going off of the dividend yield on something. That's like bro said, that's not even the stock price. So Apple can go up an extra $100. And for example, with 36,000, you probably can get, I say 30, 40 shares probably. No,
Apple,
I don't even know, probably like 30 shares
like
maybe.
Right now.
And $100 a share, if it go up $100, that's another 3 bands right there just on stock increase or stock price growth right there. And when the stock go up too, that's another thing I wanted to say. When the price of the stock go up, the dividend yield go up with it too. Like, so for example, if Apple was at $100 and they paying 25% dividend yield, you will get $25 every year on something. But if the stock go up to $200 and they still paying that same 25%, you'll be getting paid, what is it, $50 a year? Yeah, you'll be getting paid $50 a year rather than that 25 because the stock price went up and they paying you more from it on something. The dividend yield, for the people that want to know what that is, the dividend yield is what is it? The stock price divided by the yield, right?
Dividend yield is it's the stock price times the dividend yield.
Oh, and times the dividend
like
yield.
How much you would get in a year total.
Right, yeah. Throughout the whole year.
Divide that by however many times they pay it out, and that'll tell you exactly how much you would get every time you do it. Or every time
right. Yeah. If y'all want to go back and hear Bruh say that again, and y'all definitely can skip back and hear that again. But yeah, that's real good information right there, man. Let me plug in this other dividend stock that pay a little bit more, and y'all can see the returns on dividend yields that pay more.
Don't tell them the ticker, bro. If you can do it without.
Okay.
Remember the number one at like 32%? That's what you're talking about?
Yeah, it was.
Yeah, just put in the number, bro, because that we don't want to recommend this to nobody because
this is an extremely risky stock. Like the dividend literally fluctuates. Like it's not the same like a solid company like Apple. Like 1 month you would get paid 3 cents, and the next month you would get paid like 21 cents. Like so, you can't really come out with an accurate dividend yield with this stock on something. You'll just be getting paid random amounts. But the dividend yield is also high, so you'll be getting paid more. But it's also risky, though. I want y'all to remember that. Basically, if you put $1,000 in this stock that I'm talking about, the return rate is 32%.
That's
so
crazy.
basically you getting 32% on your investment every year. So 32%. I'm only say 10 years. You only put it in for 10 years, $1,000. So that's 2011. You put $1,000 in 2011 in this stock that I'm talking about with a 32% dividend yield. Oh my!
Stop playing.
That's not 1,600, bro. Oh my gosh!
Stop.
If you literally would have put $1,000, and what's so crazy? No, this company ain't come out to 2013, so I'm gonna do it like that. What's that?
So that's
11 years? No.
It came out in 13. That's 11 years. Going on 11. 8 years.
8 years. Yeah, that's what it is. Yeah. So say you bought this stock
With the IPO.
8 years ago. Yeah, that's what it did. You could have literally turned your $1,000 into almost 10 bands with this dividend stock. That's the compound. That's the power of compound growth right there.
And that's not including how much you make off the stock.
Yep.
So, you know what I mean? That's why this dividend is the truth, because this is money you get on the back end. Like, this is almost guaranteed, Brad, because dividends is not required by law to pay a dividend, but companies look at it like it's a bragging right. You know what I mean?
Right.
Like, I make this much, company make this much bread that we can afford to pay our people to own our stock, and they're gonna keep buying more. We're gonna get back to them because they're giving to us. You know what I mean? So it's been companies that have been paying dividend for 50 years.
Yeah, I think
Johnson
been paying for like 100 or something like that.
Ain't missed one payment though. So like,
I won.
You know what I mean? It ain't required by law, but this is status thing. And y'all know how companies get, man. It's all about status and clout and all that. So these companies like Coca-Cola, Johnson & Johnson, they're not cutting no dividend, bro. They gonna keep that dividend going. And the dividend increases over years, like most companies.
That's another thing too.
Dividend yield too.
Yeah.
So that's something else to keep in mind. This is just extra bread on top of what the stock price is doing.
Right, exactly. I hope y'all understand that. Like, basically, this is just literally your same $1,000 compounding, not your $1,000 invested into the stock and the stock going up. That's your same $1,000 compounding right there. That's not with the stock at all. Basically, if y'all can understand that. So yeah, with the compound interest, man, is looking real promising, man, for some returns. Yeah, within a few years on something, man. Y'all just diamond hands, hold, you know what I'm saying? Y'all gonna make a return, man. Like, long term. And for example, like, even if this stock did go down a few dollars or something like that, you would still almost even out from the return of the dividend. So if they give you $320 within that first year, and the stock go down a few dollars or a few cents or something like that, you will lose money from the stock going down, but you will also get that right back from the dividends. Like, so that's another good thing, man. And you can average down too. Once your dividends reinvest for you, it's gonna buy back at and the share price gonna be even lower. So that's gonna make your average cost down even lower. So when it go back up, you'll be making even more money. Plus, you'll be getting paid more in dividends because you bought those additional shares on something.
Sure, yes, sir.
Yeah, man. It was a nice little episode. We about to go ahead and wrap it up on something. If you got anything to say, bro, you can go ahead. I'm gonna close this out.
Yeah, man, for real, man. Like, the real investors, like the hedge funds, even rely on dividends. Like, you know what I mean? Warren Buffett spend billions in dividend companies and make millions in like.
I think he made billions back.
You know what I mean? Like, just off of dividends. So like, man, just keep in mind, man, this is not no get rich quick scheme, man. This is generational wealth. So you kind of expect it to take a generation. You know what I mean? You buy something now and you hold it for 30 years, you know what I mean? Almost a whole generation, the years. That investment you've been making over the years, that's going to millions. That's how you get the millions. You know what I mean? So don't think like, oh, that ain't enough money. I can't make enough money off of dividends. I made that mistake. Now I'm over here looking crazy.
I mean,
Don't
don't
get
nobody
that.
want to be getting no pennies. Like it might
Yeah,
look
you
like
got
pennies now, but
yeah, it's a
over time,
snowball.
man, it's gonna add up, man.
Snowball effect. It roll and get bigger and bigger and bigger. So you just got to keep
Sir.
putting money into it. Keep knowing that it don't matter what this do. I'm long as this dividend don't cut this, long as this company don't cut this dividend, and I keep
Yeah,
investing into it, I'm gonna keep making money. And by the time I'm ready to retire, I got a nice, what I mean, income.
yeah.
Plus, I got a nice bag off of the stock. You know what I
Or
mean?
if you're a little older watching this and you feel like you probably ain't got another 30 years in you, get it for your kids. You know what I'm saying?
Yeah.
Like y'all definitely can invest for your kids. Like you literally can buy stocks for your kids. Like, and just imagine you buy for them when they 2-3 years old, they wait 15 years, they 18 now. That's a long time for all that compound growth right there. Like
Yeah.
everybody that got all these loans and all this bread, throw something for your kid, man, so they can make 10 bands in a few years. Like, come on now, man. Like,
and the more money you put into it, the more you get out. Like if you throw 100K into all dividend stocks, that can make you 10 bands a year.
yeah,
Like
exactly.
it just take
Definitely
100K.
can. The
You
more
can
money
make
you got
10 bands
invested, the more you're gonna get out.
clearly just off of dividends, not even off the stock going up. You can make 10 bands just off of monthly payments or quarterly payments that they're giving you.
Yes, sir.
It take a large bag to do that, but if you ain't got a large bag, you can build up to that bag over the years.
Exactly.
You know what I mean? And that's
And
what
it's gonna come quicker as well because
yeah.
you reinvesting it over time.
Yep.
Yeah. So yeah, that's it, man. Stock plug investments, man. We're gonna be back on here on Sunday on Instagram. Y'all follow Stock Plug Investments on Instagram. We're gonna be talking about financial literacy, different stuff about financials, basically. We ain't gonna be talking about stocks really, but
and
if
we don't see y'all on Saturday, man, happy Juneteenth to everybody out there, man.
Yeah, and happy Father's Day for everybody too, all of the fathers out there, man.
Yes, sir.
But yeah, that's it, man. Stock plug investments, man. We don't give y'all a stock, man. We give y'all or we show y'all how to find good stocks, man, so y'all can plug yourselves, man.
Most definitely.
That's it, man. We out, man. We gonna see y'all Sunday, man. Happy Juneteenth, happy Father's Day.
Most definitely.